Welcome back to the Economic Analyst channel. In this video, I'm going to give you a broad overview of the stock market inside the United States for 2023 and going forward. My intention is as I create more of these videos, and I'll probably create a playlist for the stock market, is to start drilling down into more of the details, start going into specific stock indices and their subcategories and how they are performing compared to economic macro fundamentals. But this is just giving you a broad overview and sort of a review and a recap and an update of previous videos that I have made in the past for the stock market. But this will kind of give you more of a in-depth background as to how I am approaching the current market situation that we are facing right now. So this chart here depicts the stock market capitalization over time in terms of the stock market capitalization in this blue line right here. You can see that this is the stock market and how it has been trending upward over time. The orange line is my valuation tool metric that I have recently calculated using the 30-year Treasury rate and the 5-year GDP growth rate and comparing that to nominal GDP, taking that multiplier of the 5-year GDP growth rate, dividing the 30-year Treasury rate from that, and multiplying it by nominal GDP and showing how it strongly correlates with stock market capitalization. So in other words, Warren Buffett once discovered the formula for valuing stocks numerically by taking future cash flows, estimated future cash flows, and comparing that to the risk-free 30-year Treasury rate. That was what he would call the risk-free interest rate, and using that as a metric to value stocks, whether they were overvalued or undervalued, and to make his positions accordingly. Well, it turns out that on a macroeconomic level, Buffett's thesis is correct, knock on wood, when it comes to the market. If you take the broad market income, which is GDP, and you take its growth rate and compare it to the risk-free interest rate, you get this orange line interest rate valuation, and it shows that in large part, investors value the stock market according to this valuation metric tool, whether knowingly or unknowingly, they are following Buffett's thesis on this in broad. So if you can predict what's going to happen with interest rates and GDP growth, which is nearly impossible, but if you could, theoretically, you could dictate whether and know whether the stock market was going to increase, whether it was going to drop, whether it's going to be a bullish sign for markets or bearish signs for markets. Now, this green line here is the gross private product. It is the gross domestic product and subtracting out the government consumptions and investment expenditure portion of GDP to get the private income. And what I'm depicting here is showing that the stock market capitalization was largely equal to gross private product until the mid-1990s. This is when stock bubbles started to form due to low interest rate, generous Fed monetary policies. What happened here is that the Federal Reserve's consecutive and cumulative low interest rate monetary policies that from Alan Greenspan lowering interest rates in the mid-80s had created a over-bearish signal in the market where it started to drive the stock market capitalization up and up and up, and that's because the interest rate valuation started to increase because the 30-year Treasury rate was being driven lower and lower and lower beyond the macroeconomic fundamentals, which is represented in this green line, that is the GPP. And as with the previous two bubbles, after a time of overinvestment and irrational exuberance, as Alan Greenspan would call it, we would see spectacular collapses in stock prices, usually happening on a very sudden basis as big corporations and big businesses started to go bankrupt from malinvestments, and we would see these sharp corrections in the stock market. Looking at the current stock market situation now, you can see why many doom and gloomers, perma-bears, Austrian economists, etc., are very worried that this financial collapse that we are looking at could be far worse than what we saw in 2008 and the year 2000. By looking at this metric alone, it would seem to indicate that if the stock market were to collapse, it would collapse on a more severe basis, percentage-wise, than what we were looking at in 2000 and 2008. So for a frame of reference, in the year 2000, the stock market was overvalued to the private product by 100%. So it was overvalued 2 to 1. In 2006 and 2007, the stock market was overvalued by about 50% or 1.5 to 1. Well, currently, the stock market is overvalued by 111% or over 2 to 1. So the stock market right now is more overvalued than it was during the height of the tech bubble, using broad market capitalization and comparing it to 1 year's economic income. At the peak of the stock bubble in 2021, before the Fed's higher interest rate policies started to force this valuation down and the stock market along with it, the stock market was overvalued by nearly 3 to 1. That's a 178% increase above that private product level. That's the biggest stock bubble that we have seen in the history of the United States since 1929. And so that has caused many doom and gloomers to fear that if this market were to correct all the way down to this private product level, that it would signal the worst recession that we have seen, possibly the next Great Depression. Let's take a look at it on an exponential basis here, okay? So long term, we can see how the stock market compared to the gross private product was very undervalued during the 1970s. So in other words, during these high inflation, high interest rate policies that were contributing and generous monetary policy, this contributed to an overall malaise inside of investor sentiment in the stock market. Stocks were seen as the pariah of the economy and a bad valuation tool. As a matter of fact, if you bought stocks in 1970 and then sold in 1980, you would have made maybe 30% off of your investment over the course of 10 years. So you would have barely made 2 to 3%, but that was with inflation rates reaching as high as 10 to 15% year over year at that time. And so you would have actually lost money. And this bearishness toward the U.S. stock market was what contributed to gold's historic outperformance during the 1970s. And you have to remember that one of the reasons why the stock market collapsed so badly during 1972 and 1973 was because the United States was taken off the gold standard. The US dollar was taken off the gold standard, and Richard Nixon, in order to try to control price inflation, instituted wage price controls, which started to deteriorate profits in Wall Street and caused this really bad bearishness in the markets. And truth be told, the stock market capitalization really did not recover back to its long-term valuation of gross private product until the mid-1990s. And then something happened. Something interesting happened at this point. And that is that when the stock market collapsed and was 50% of its long-term value in 1974, a change in sentiment happened in the mid-1990s. It went from being bearish to over bullish. So we went from an over bearish scenario to an over bullish scenario. We went from where the stock market was valued at 50% to gross private product to where it was valued at nearly 3 to 1 to gross private product, or 178% above the private product level. So we shifted from this over bearish scenario to this over bullish scenario. What caused this? Well, in the 1980s, when interest rates peaked, for the last 40 years, interest rate policies from the Federal Reserve have been bringing down the long-term 30-year Treasury rate lower and lower and lower as time goes on. And outside of some spectacular stock market crashes, which really just corrected the capitalization down to the gross private product level, the stock market has been on a terrific bull market run since really 1980. And until recently, we've only just begun to see the pivot and in turn, maybe the hallmarking the next bear market in the stock market. But whether it will become a bear market and return back to these 1970s levels where it actually trades below its long-term value of gross private product remains to be seen. My inclination is that that will not happen. I'll give you my assessment of where I think it's going to, what's happening in the broad market stock market in the next set of slides. So the over bearish scenario lasted for 20 years, okay? Keep that in mind, that this, even though the market started to pick back up in 1980s with great returns, it was really just catching up to its long-term value. But this over bearish scenario on the stock market, the favoring of bonds and higher interest rates, and especially precious metals, assets, and commodities to financial contracts in the stock market, this lasted for nearly 20 years. This over bullish run has lasted for 30 years. And just recently, we've just started to see this turn in the stock market to head downward, driven by higher interest rate policies from the Fed. Whether this will manifest like 2008 or the year 2000 or something even worse remains to be seen. And it's unknown whether this is going to mark the end of the over bullish era of our markets, or if this is just another downward trend in a much larger bull market length run. We'll see. So let's take a look at what some of the driving factors is in the stock market sentiment. So you can see here that the red line is the consumer price index, and you can see how it has spectacularly increased by over 20% in the last 3 years, driven by ultra low interest rate policies and the money supply increasing by 50% as the Federal Reserve started to sop up excess debt, print money, and provide fresh liquidity to the banks in the wake of the COVID pandemic crisis in 2020. As a result, commodity prices and wages, which is measured in this blue line, started to skyrocket, which is bidding up this consumer price index. Now, while commodity prices have corrected in the last 6 months, wages are still being bid up, and this is causing worry for the Fed that price inflation is not over with, even though we're seeing annual growth rates in the CPI correct. The Fed is worried that these higher wages are still going to push up inflation in the long run, so they're going to continue with tighter and higher interest rate policies. When we take a look at and break down the components of my business expense index, we can see the producer price index and commodities in red have this sharp correction starting around July, June of 2022. And we're seeing the annual growth rates really spectacularly plummet. That's a great sign. But on the consequence, on the other side of this, has been wages, which is measured in blue. Wages are being bid up, and so now wage inflation is reaching the consumer price index inflation, and so the Fed is worried that this building wage inflation will contribute to more purchases of consumer goods, higher demand for consumer goods, keeping those consumer prices elevated and from correcting downward. On the flip side of this, even though the Federal Reserve is starting to raise interest rates and they're hiking interest rates at the sharpest pace since Paul Volcker in the early 1980s, the real Fed funds rate is still negative compared to the consumer price index inflation rate. And so while the consumer price index inflation rate has corrected down to about 6.5% year over year, the real federal funds rate is still around 4.75%, so it's still roughly negative. This has caused many analysts, investors, and doom and gloomers to worry that the Federal Reserve is still not doing enough to bring down the inflation rate, even though we're seeing a sharp correction in commodity prices. So that leads me to my stock market analysis and projecting off of that. Where do I think that the stock market is headed? Am I expecting a collapse down to the private product level like we saw in 2008 in the year 2000? Well, I don't think so. I think that the coming recession is going to be milder in terms of severity of a correction than what we saw in previous bubbles. And the reason why is because I do think that even though the Federal Reserve is tightening its monetary policy and raising interest rates, the amount of liquidity that it has injected into the economy has still caused a massive credit bubble, and interest rates are still relatively low to price inflation, where it's still generally buoying the nominal spending of the economy, which is why I don't think we're going to see a severe recession. In other words, what we are seeing with high inflation is that we've seen our wealth erode over the last 2 years from high inflation, and that's really contributed to more of a depression scenario, but it may not manifest in some sharp financial crisis recession like we saw in 2008, unless if the economic fundamentals start deteriorating very severely. When we take a look at the interest rate values compared to my stock market analysis on the capitalization, I think that largely the stock market projection will correspond with the interest rate valuation. It seems to be doing that since about 2018. There have been times when the stock market will deviate very strongly from the interest rate valuation. You can see this in the mid-2015s. You can see this in post-2008. You can see this in the run-up of the bubble in the year 2000. So it is quite possible that the stock market could start gaining ground, start increasing in price, or may not correct as much as what I am projecting here. But if the stock market were to follow where I think interest rates are headed in GDP growth, then I think that we are indeed due for a correction in the stock market, but it's not going to be the sharp collapse like we saw in 2008 and the year 2000, because I don't think that this coming recession is going to be as severe. As I've covered in my last video, the cost and quantity of debt to income has not reached the territory levels of the year 2008 in terms of that, and unless if the quality of debt is much worse than 08, we're probably just not going to see that bad of a collapse. And unless if the Fed were to really start strongly hiking interest rates continuously and getting the federal funds rate up to say 7 or 8%, we're probably not going to see the market correct like it did during the year 2000. And you have to remember, much of that correction was because the stock market was way overvalued compared to its interest rate and GDP growth. And we're not seeing that right now. The stock market is pretty much valuing itself according to the interest rates. So it is unlikely that we are going to see that sharp correction in the year 2000. And unless if the quality of debt from all of the loans to businesses during the pandemic is as bad as it was in 2008 or really worse, then we're probably just not going to see that sharp collapse and a financial crisis manifest. So when we take a look at the past market correction in the year 2000, that correction was 40% peak to trough. So the stock market peaked and then it dropped by 40% over the course of 2 years. In 2007, 2008, the stock market corrected by 45%, almost chopping in half from peak to trough in a matter of about a year and a half. Where do I think that we are headed now in this current market environment? We'll peak to trough. And remember, I'm showing the peak of the stock market back in 2021. We're probably looking at something of along a 30% correction. So where we are right now is we're about 10 to 15% corrected from the peak. So we probably will see another 10 to 15% in the stock market capitalization reaching this 30% level from where we are right now. And again, this troughing will probably bottom out when the recession starts to manifest in the middle of 2024. And guys, that's all that I have for this video. I hope that you enjoyed my content that I provided to you. If you do, please like, subscribe, and comment, and let me know your thoughts on this below. Again, I will provide further updates to these videos and start drilling down into more of the details covering the specific indices and categories in the stock market. For the next video, I will probably cover the precious metals, give a broad metric update on what's going on there, and then move forward. Once again, guys, I thank you for watching this video, and I'll talk to you next time.